Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dongyue Group Limited Annual Report. Dongyue Group Limited is a diversified investment holding company that operates through various segments to provide a wide range of products and services. At its core, the company manufactures and distributes polymers, organic silicone, refrigerants, dichloromethane, liquid alkali, and other chemicals. In addition to its manufacturing operations, Dongyue Group also engages in property development and rental, as well as the sale of chemical products. The company has a strong focus on research and development, investing in the creation of new fluorosilicone materials through its management of the fluorosilicone industry. Furthermore, Dongyue Group provides various utility services, including the production and supply of electricity, heat, gas, and water. The company also offers environmental monitoring and sewage disposal services to support sustainable practices. In terms of business operations, Dongyue Group provides consulting services to help other companies manage their businesses effectively. Overall, the company's diverse range of products and services makes it a significant player in the chemical industry and beyond. Dongyue Group Limited market capitalization of 19 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Dongyue Group Limited holds a significant advantage in their industry. Dongyue Group Limited trades at a lower price-to-earnings ratio of 10 times and a higher price-to-book ratio of 1.2 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 2.67%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. On the positive side, the polymers segment experienced a significant increase of plus 10.9%, driven by the dichloroorganic polymers segment, which saw an external sales growth of 3.93%. The refrigerant segment also showed promise with a plus 21.6% growth in external sales. On the other hand, revenue decline was observed in certain segments such as the refrigerant segment, which experienced a minus 23.8% drop, and the organic silicon segment, which saw a decline of minus 26.6%. The market environment, decrease in average selling prices, and production accidents were cited as contributing factors to this decline. Geographically, revenue growth was seen in the PRC with a plus 13.4% increase, while overseas markets experienced a decline of minus 11.3%. These trends highlight the importance of segment-specific and geographic drivers in determining a company's overall revenue performance. The net income of the company experienced a significant increase in 2025 compared to 2024, rising by 121% from RMB 987,497,000 to RMB 183,593,000. This substantial growth can be attributed to various factors that contributed to improved profit margins. One key factor was the increase in gross profit margin, which rose from 21.62% to 30.81%. This significant improvement suggests that the company has successfully optimized its production costs and pricing strategies. Additionally, the operating margin also saw a notable increase from 10.01% to 17.9%, indicating enhanced operational efficiency. However, not all segments of the business experienced growth. The organic silicon segment reported a decrease in net income by RMB 153.379 million, while the dichloromethane and liquid alkali segment saw a decline of RMB 14.108 million. These decreases may be attributed to various factors such as market fluctuations or internal operational issues. Despite these setbacks, the overall trend indicates that the company has made significant strides in improving its financial performance. The substantial increase in net income and profit margins suggests that the company's strategies are yielding positive results, positioning it for continued growth and success. The company's financial performance indicates a significant improvement in its ability to generate positive operating cash flow. In 2024, the total operating cash flow was RMB 240,082, while in 2025 it increased to RMB 680,697. This increase is also reflected in the net cash inflow from operating activities, which rose from RMB 71,697,000 in 2024 to RMB 3,706,493,000 in 2025. These figures demonstrate a substantial growth in the company's ability to generate positive operating cash flow, indicating a strong financial position and improved management of its operations. The company's financial performance varied across different segments and regions. On the positive side, refrigerants were a standout performer, with revenue increasing significantly from RMB 3,247,702 to RMB 4,940,752. This growth was consistent over 2 years, indicating a strong market presence. Dichloromethane and liquid alkali also showed impressive performance, with revenue increasing from RMB 1,104,337 to RMB 1,223,300. Additionally, dichlororganic polymers performed well in 2025, achieving segment results of RMB 356,642. However, some segments struggled. Organic silicon saw a decline in revenue from RMB 5,212,703 to RMB 3,824,405, indicating a loss of market share or decreased demand. Silicon also underperformed in 2025, with segment results showing a significant loss of RMB 51,711. Eliminations was another poorly performing segment, experiencing poor performance in both 2024 and 2025. These results suggest that the company needs to reassess its strategies for these segments to improve their financial outcomes. Management's outlook on company strategy. The company's management has provided insight into its future plans and priorities. One key aspect is the continued investment in TAE and Hainan Guji, which are seen as crucial to the company's long-term strategic goals. This commitment to these investments suggests that the company is focused on building a strong foundation for growth. In terms of shareholder returns, management recommends a final dividend of $0.30 per share. This indicates a focus on rewarding investors while also maintaining a stable financial position. The fact that the chairman and chief executive officer hold the same position is seen as a strength, allowing for more effective leadership and planning. Overall, these statements suggest a company that is prioritizing strategic growth and responsible financial management. The company has made significant investments through acquisitions and divestitures in recent times. In terms of acquisitions, the company has invested a substantial amount in 2 key entities, TAE and Hainan Guji. The acquisition of TAE involved an investment of RMB 600 million, while the acquisition of Hainan Guji saw an investment of RMB 278.5 million. On the other hand, the company has also made strategic decisions to divest from certain investments. One notable example is the divestiture of its stake in Hainan Guji, which resulted in a refund of RMB 39.2 million. This move was likely aimed at reducing the company's exposure and risk associated with this particular investment. As a result of this divestiture, the company's investment in Hainan Guji has been significantly reduced to RMB 897,000. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which have been consistently distributed over the past 2 years. In 2025, each shareholder received HK$0.30 per share, while in 2024, they received HK$0.10 per share. In addition to dividend payments, the company has also taken steps to return value to its shareholders through share buybacks. A significant number of shares were canceled in 2024 totaling 520,978,000. This move not only reduces the outstanding share count, but also increases the earnings per share for existing investors, thereby enhancing their overall returns. Concerns have been raised regarding the potential for inventory buildup and supply chain disruptions. One specific incident that has contributed to these concerns is the production accident at Dongyue Organosilicon, which resulted in a temporary shutdown of their facilities and significant stoppage losses. This incident highlights the vulnerability of supply chains to unexpected events. The shutdown not only affected Dongyue's operations, but also had a ripple effect on the broader supply chain, potentially leading to inventory buildup as production was halted. That concludes the financial summary for Dongyue Group Limited. Feel free to comment below, and I will be happy to answer them when possible.